I greatly appreciate everyone joining this live chat session. After this session, you'll understand more about digital currencies, what they are, the types of digital currencies, and a few advantages and disadvantages of digital currency platforms. Before I set up this topic for today's live chat, I'd like to cover how you can participate in this live chat. It's really easy. All you have to do is raise your hand by using the icon in the chat menu. Also, please feel free to hit any emoji reaction to let me know how you're feeling about this live chat. I am recording this session audio for rebroadcasting and to have an archive recording. This session's topic is, what is digital currency? As the digital economy continues to expand, the use of digital currency is also increasing rapidly. Digital currency is money in an electronic form exchanged for goods and services without the use of physical money such as paper bills or coins. Technology is growing and evolving, and as a result, digital currency is steadily replacing physical money. Here's what you need to know about the types of digital currencies and the advantages and disadvantages of digital currency. Let's get into this topic. What is a digital currency? As technology advances, so does digital currency. An early form of digital money was the electronic exchange of cash between bank accounts or an electronic payment utilizing credit. This still takes place most commonly by debit or credit cards, with a bank-to-bank electronic wires, an online payment system, or the use of a smartphone that carries a user's payment information. Digital money today mostly facilitates the movement of fiat currency. That's money issued and backed by a government such as the US dollar, the Canadian dollar, or the euro. But digital currency now also includes cryptocurrencies. Bitcoin, for example, is the original cryptocurrency and was privately developed as a means of exchange on the internet. Since its creation in 2009, Bitcoin has been accepted by some investors as a store of value, which is an asset that can be saved for later with the reasonable belief that it will not depreciate in value. After Bitcoin, thousands of cryptocurrencies were developed for various uses in digital economy and the real world. Many governments that issue fiat currencies also considering developing their own digital currency as a variant of traditional money they already create. What makes a digital currency? Money in digital form, such as dollars sitting in your bank account, is a type of digital currency, but it isn't the same as cryptocurrency. The reason is that money in digital form can be converted into physical cash. For example, when you visit an ATM machine. When making a withdrawal, traditional money in its digital form can be used to facilitate electronic payments by card at a physical merchant and online. But there are some differences between it and money built as an actual digital currency. Money in its current form, including digital forms of cash on deposit at the bank, is created and distributed by a central bank. Think of the US dollar, which is printed by the US Treasury and distributed by the Federal Reserve. In a centralized process, a system of serial numbers is usually used to make sure each note is unique. Bank partners are used to distribute cash into the economy. A digital currency, such as cryptocurrencies, however, makes use of an electronic ledger system to create a network of computing nodes to process transactions. Cryptography is often used to make user identities and transaction details anonymous. A digital currency can also bypass bank and financial institution intermediaries and be provided directly to users. The Internal Revenue Service, or the IRS, defines digital currency as a virtual currency if it functions as a medium of exchange, a unit of account, and or a store of value. The IRS defines Bitcoin as a type of convertible virtual currency since it can be easily exchanged for US dollars. In this context, virtual currency purchases and sales will trigger taxable events per the IRS. Now, types of digital currencies. There are currently three basic types of digital currencies in development or circulation. Central bank digital currencies. A growing list of money issuing governments are considering issuing digital versions of their fiat currencies, known as central bank digital currencies or CBDC. For example, China is currently testing its digital renewable CNY to facilitate cross-border payments and circumvent existing digital payment channels. Chinese e-commerce giant JD.com started accepting eCNY payments from customers in late 2021. The U.S. Federal Reserve is also studying digital currency and working on a plan for its own CBDC. Other countries, such as Switzerland, continually study the impact of CBDCs on the economy, but currently have no plan to implement them. Cryptocurrencies are developed by private parties independent from a central bank or government institution. Cryptos make use of blockchain technology, a digital ledger system that records crypto transactions. Most cryptocurrencies also use cryptography to make the digital currency tamper resistant and the network more secure. Also, I'll mention that blockchain technology operates on a digital ledger and can be accessed by the general public. But the blockchain doesn't record your personal data. Instead, your digital wallet is under a pseudonym. Some folks have this level of anonymity appealing, as their financial dealings are protected by a level of confidentiality. Let me add this in addition to what I just mentioned earlier. Cryptocurrency is a form of decentralized digital currency. The reason it's referred to as cryptocurrency is that it requires a cryptography rather than a central authority to manage its ledgers and balances, since the currency is decentralized. Today, the most common form of ledger system for cryptocurrency to use is blockchain technology. Two largest cryptocurrencies are Bitcoin and Ethereum. A growing list of companies are either working on blockchain and crypto development or using cryptocurrencies in their operations. Unlike CBDCs, cryptocurrencies are decentralized, meaning there is no single party responsible for issuing or changing the currency. Next is stablecoins. Stablecoins are a type of cryptocurrency and make use of blockchain technology and cryptography. The key difference between stablecoins and traditional cryptocurrencies, however, is that stablecoins are backed by a reserve asset such as the US dollar or gold, and they are designed not to fluctuate in value like traditional cryptos. They will instead track the value of an asset that backs them. There are three main types of stablecoins: off-chain or fiat collateralized. These stablecoins are fully collateralized by dollar-denominated assets and are backed by bank deposits and similar cash-like assets. Custodians are required to safely keep collateral assets until stablecoins are redeemed. On-chain or crypto collateralized. These stablecoins are collateralized by crypto assets and are backed by tokens on a blockchain. These stablecoins don't require issuers or custodians to redeem claims. And the last is algorithmic stablecoins. These are stablecoins with value that is controlled through an algorithm and may not be pegged to real-world assets. Tether is currently one of the largest stablecoins. Meta Platforms, which was formerly Facebook, was also developing a stablecoin project called Diem, but it recently sold the crypto asset to a bank, Silvergate Capital, which intends to launch its own stablecoin sometime in 2023. Advantages and disadvantages of digital currency. As with all technology, digital currency solves some of the problems associated with traditional money. There are also concerns and drawbacks. Now, here are some of the pros of digital currency. First, digital currency speeds transaction times. The modern financial infrastructure is made up of a complex web of participants, in some instances, like a fully decentralized digital ledger system. Two parties can transact business directly without any bank or financial institution intermediaries. That avoids payment settlement times that can traditionally take days, and depending on the dollar amount, even weeks. Secondly, digital currency can reduce costs. With the elimination of some of all intermediaries, transaction fees associated with digital payments can be greatly reduced. This is especially the case with the high costs associated with the cross-border movement of money. Next, physical money has security issues. Risk of theft, forgery, and the need for physical storage at a bank can be reduced or eliminated with digital currency. Another pro, some digital currencies, such as cryptocurrencies, aim to decentralize monetary policy and can include people in the distribution of currency previously handled by a central bank's financial institution partners. And last, pro, digital currency technology automates accounting and other record keeping, saving time and expenses for issuers, merchants, and everyday users. So let's talk about some of the cons of digital currencies. First, since it's a computing technology, digital currency is not immune to hacking and other cybercrimes. If an economy adopted digital currency, financial stability and national security could become a cybersecurity risk. Second, cash is anonymous, but digital transactions can be tracked. While most digital currencies seek to be anonymous when it comes to user identity, transactions will leave a trail. Third, digital currency reduces traditional transaction costs, but it also carries its own unique set of expenses. Cybersecurity costs are one. Many cryptocurrency users, for example, choose to store their digital assets in a crypto wallet, a piece of hardware that can be disconnected from the internet, which is known as cold storage. Blockchain-based payments also have to pay fees associated with the computing transactions. And the last con, digital currency presents new challenges for regulators and policymakers trying to ensure financial stability. So what's the future of digital currency? Digital currencies are still in the early days of development. Cryptocurrency values have skyrocketed in recent years as various companies have expressed interest in building new services and products with them, and investors have increasingly viewed cryptos as an investment asset class. Central banks that create and back fiat currency may also alter the landscape if they begin issuing their own digital currency. The future for digital currency and other digital assets utilizing them is in flux, but the steady expansion of technology bodes well for the proliferation of various electronic forms of money and payment. It's possible to invest in this development via cryptocurrencies, stable coins, company stocks involved in their creation and use, so it's an exciting realm for investors to explore. Just remember to stay diversified and focus on long term if you choose to invest in the digital currency movement. Now, how would digital currency affect you? If the US adopts a digital currency, and understand recently in the news, this is where everything is heading here in the United States, it would work as an alternative to cash, but would also have the built-in advantage of quick money transfer since it's electronic. According to the Atlantic Council Geoeconomic Center, bank digital currency has few ideas on what would look like for consumers. Quote, our presumption is that it will be free or near free like cash. Other private sector players may innovate on top of it and possibly additional fees, but it has to be fleshed out more. Even though a digital currency would be electronic, it still needs to be accessible as cash. Another quote from the council, anyone should be able to use it, not just those with the latest smartphones. End quote. According to the Atlantic Council Geoeconomics Center's central bank digital currency, suggesting chip-based cards, point-of-sale systems, and web accounts as alternative ways to access the CBDC, they believe a way can be to handle the transactions offline, that it will have to be developed so that two people can exchange CBDC even that they aren't on the same network or online at the same time. There's a lot that can be done and a lot of industry input is needed, but it could be well worth the investment. Now, before I go in a little further here, does anyone have any comments, insights, or questions that we want to add to this chat session? Feel free to use the raise your hand, and what I can do is open up your mic and bring you up on stage, and you can ask a question or add to the commentary here, or if you have any insights. Okay, well, while I'm continuing on, if you do, feel free to raise your hand. Now, let me talk about how you can support content like we covered in this session. I have set up an affiliate program with coffeebrandcoffee.com, and you can save up to 5% off your orders of quality premium coffee, tea, and more by using coupon code CODINGSTALK. One word, CODINGSTALK, when you finalize your order. So please help offset the cost of creating, producing, streaming this content and other content by visiting coffeebrandcoffee.com and using coupon code CODINGSTALK during your order checkout, and you'll save 5%. So that being said, I seem to have run out of my material and I didn't realize this. So any questions, any comments, any additional insights that you would like to add to this live chat, feel free to raise your hand. All right, everybody. Well, I greatly appreciate this opportunity. And next Tuesday, I'm going to be covering Cryptocurrency 101, and that will be on Tuesday, July 18th, starting at 7 p.m. Eastern Daylight Time. So no matter where you're calling or where you're from right now, have a good morning, good afternoon, good evening. Thank you, everybody.